Asia is the physical center of global trade, sitting at the junction of the world's most critical maritime routes and supply chains. By 2025, the region generated 31% of global GDP, while housing 56% of all listed companies. Yet this economic footprint is not reflected in the capital stack, where its share of global debt and venture capital exits remains disproportionately small. This imbalance faced a severe test in early 2025, as renewed tariff uncertainty collided with escalating geopolitical tensions in the Middle East. Because the region's production networks are built on export-driven trade, any friction in global logistics creates an immediate, localized shock to Asian economies. Investors reacted to this vulnerability with a sudden spike in equity market volatility throughout early 2025. Deep integration into global trade guarantees Asian markets face extreme exposure to external geopolitical repricing. This physical infrastructure is supported by the architecture of the capital markets that finance it. But there is a profound disconnect here. Despite hosting over half the world's public companies and demonstrating high corporate growth, Asian equity valuations lag severely behind the rest of the world. This undervaluation extends beyond stocks. Corporate debt segments like private credit and syndicated lending remain significantly underdeveloped relative to the region's GDP. Understanding the future of global finance requires an analysis of how these markets are restructuring their valuations and debt pipelines to survive. Internal structural inefficiencies represent a far more persistent threat to regional growth than external tariffs, acting as a constant drain on trillions in market value. We can quantify this anomaly by looking at the specific metrics that define the regional equity markets. This chart tracks the price-to-book ratios of listed firms across Asia. Nearly 40% of these companies currently trade below a ratio of 1.0. This means the public market values these active businesses at less than the liquidated sum of their physical assets. One major cause is capital allocation. Compared to Western markets, Asian firms have historically provided persistently modest shareholder returns, particularly in dividend yields. Furthermore, highly concentrated corporate ownership structures often prioritize maintaining executive control over improving capital efficiency. The combination of low payouts and insular ownership creates a significant barrier for large global institutional investors looking to allocate capital to the region. This 40% discount represents a structural penalty for poor capital allocation, a systemic issue that persists even when the macro volatility of 2025 subsides. Regional regulators have responded to this undervaluation by introducing a series of coordinated policies known as value-up initiatives. These frameworks mandate that listed companies publicly disclose and actively improve their capital efficiency metrics. Operationally, these policies push firms to execute systematic share buybacks to reduce equity dilution. They also demand higher and more consistent dividend payout ratios to reward shareholders directly. Beyond financial metrics, value-up initiatives target corporate governance, using transparency requirements to dismantle the opacity often found in concentrated ownership structures. These initiatives represent a regulatory attempt to enforce the strict capital discipline that the Asian public markets previously failed to generate on their own. While regulators focus on long-term value, non-financial firms had to find alternative ways to raise capital during the 2025 volatility. The traditional initial public offering market cooled significantly as equity prices fluctuated, closing the front door for many growing companies. As the IPO pipeline constricted, corporations rerouted their financing needs through other channels. Already listed companies relied heavily on secondary equity offerings to tap existing shareholders for capital. Simultaneously, the corporate bond market surged as firms bypassed the unpredictability of equity markets entirely. By bypassing IPOs and relying on secondary debt and equity, Asian corporations were able to maintain their growth engines despite the geopolitical shocks of 2025. This reliance on debt highlights a major divergence in asset classes. While equities saw significant outflows in 2025, capital actually moved into Asian debt markets. This chart shows the stability of Asian bond spreads, even as global risk indicators spiked violently throughout the year. High underlying credit quality among both sovereign and corporate issuers provided the first layer of protection against the global panic. More importantly, a massive captive domestic investor base holds the majority of this debt. This localized ownership effectively insulated the bond markets from the sudden capital flight often seen among foreign portfolio investors. As a result, Asian sovereign bond issuance reached a record high of $4.1 trillion in 2025. The domestically anchored structure of these debt markets served as the region's primary macroeconomic shock absorber throughout the 2025 crises. Despite the resilience of bonds, there are still significant gaps in the region's capital stack. Private credit and syndicated lending remain severely underrepresented when compared to Asia's footprint in the global economy. Outside of traditional public markets, venture capital provides a different look at the region's financing horizons. While overall funding has cooled, venture capital remains robust in advanced sectors, with investment in AI-related startups distinctly localized over China. The rapid expansion of these digital sectors, including crypto assets, now requires closer cross-border regulatory coordination to handle new market risks. The sheer scale of the Asian economic engine is visible in its ports and production numbers, but the next stage of development cannot rely on export volume or the number of listed companies alone. The continued growth of the Asian economic engine requires structural reforms that demand capital efficiency and reconcile the massive valuation gap in regional equities.